Excel accounting practice problem. Subaccounts categories for fixed assets or depreciable assets, property, plant, and equipment. Get ready because we're about to excel. Here we are in our Excel worksheet. In prior presentations, we put together the worksheet from a blank sheet, now continuing to enter transactions into it. If you have access to it, there's two tabs on down below, an example tab and a practice tab. The practice tab starting out where we left off last time. The example tab, in essence, being an answer key. Let's take a look at it now. So in prior presentations, we've been entering transactions into our property, plants, and equipment, our fixed assets. You might hear them called depreciable assets, the PP and E, those being the items that when we purchase them, we don't expense them, but rather put them on the books as an asset, equipment, furniture and fixture, machinery, the buildings, and so on. And then we allocate the expense of them, the cost of them, over the time frame in which we consume them, that being an accrual concept, an accrual concept that most people cannot even escape, even if they want to be on a cash basis, given the fact that when you do your taxes, the tax code usually has implemented into it some kind of accrual basis with regards to property, plant, and equipment. So you can't really get around this one typically. Even if you're on a cash basis, you got to do this kind of accrual type of thing. So then the question is, when you put it on the books as an asset then and allocate it out, what should be your categories when you put them on the books as an asset? And you might say, well, I can just choose the categories which fit my business best. And you can kind of do that, but you also want to think about how they're going to be lining up to your subledger, a subledger being similar to a subledger for like accounts receivable or inventory, but the subledger for the property, plant, and equipment often not being inside the same software as the accounting software. So even when you're using accounting software like a QuickBooks or something like that, you might not be tracking the subledger in the QuickBooks software, because it can get, one, quite complicated, and two, you often need multiple formats of the depreciation schedule, one of them being a tax format of the depreciation schedule, the tax format changing every year and can get quite complex, and one which you're going to need to be doing in an outside software other than your accounting software, the tax software, in order to file your tax return. So it becomes a duplicate or doing twice the work kind of thing if you're going to be doing the tracking the information both in your side, on your accounting side, as well as on the tax side of things, because you could just use the tax software to be the complement to help you with the data input. Now, the tax depreciation schedules may be different. The tax code has its own kind of rules for depreciation schedule which take into account other things other than just reporting in the most accurate kind of basis. So, but the tax software usually can also make a book depreciation schedule once you have it input into the system. So it might look something like this, where you've got a depreciation schedule for the books, and then the same software can basically make the tax schedule as well. So now you got the tax depreciation to do the tax return and the book depreciation in the same software, which will most likely be the tax software, which would be the easiest place to house that. So if that's the case, then the next thing you want to think about, well, how can I make my adjusting entries as easy as possible if I'm dependent on tax software in order to make those adjusting entries? What you generally want to do then is make your categories line up to the categories in the tax software that you're going to be using, which generally lines up to basically what the tax code will be saying, even if you're going to be using a book basis. So that's going to be the general idea. We're going to say, now I'm going to adjust my accounts here to line up to what I expect to see on the tax code. Now, the other thing you want to keep in mind is that you could still kind of simplify things. So if this, for example, was the schedule, the sub-schedule from the tax return, notice it breaks out all of the detail of the particular items that are in each category, furniture and fixture, machinery, and so on and so forth, and then gives the total. Now, you could then use these two categories. That's one method you can use, breaking out those two categories, or you could just still use one account called property, plant, and equipment if you wanted to make it easier, and then just use that one account and then the depreciation one account, and then just look at the totals from your depreciation schedule. So that would mean you'd have less detail on your financial statements. The second easiest thing to do is to break out your financial statements in the same categories for the actual property, plant, and equipment accounts, here being furniture and fixture and machinery and equipment, and then possibly only have one accumulated depreciation account instead of having multiple accumulated depreciation accounts, which again will combine everything into one account with regards to the accumulated depreciation and the depreciation expense. That's the second method you can use that's still pretty easy. The third method that you can use, and this would be a little bit more detail, would be, and this is probably the detail that many people will kind of choose oftentimes, is you could say, I'm going to have different categories for my property, plant, and equipment and a related category for the accumulated depreciation. Therefore, I will have a furniture and fixture account and a related accumulated depreciation account, the difference between the two being the book value for the category of furniture and fixture, which includes all this stuff inside of that category. And then I'll have my machinery and equipment category and accumulated depreciation account related to it, the difference between the two of those accounts being the book value related to the category of machinery and equipment. Then you could still decide to have the other account go into just one depreciation account, or you can have multiple depreciation expense accounts for the categories as well. So we're going to be worried on the balance sheet side of things at this point in time, looking at the categorization. Notice that the detail of the sofa and the chair under the furniture and fixtures and so on is going to be what you need to do from period to period is think about the additions and subtractions to things that you bought and sold or disposed of during the period. All the old stuff that you're still holding on to will already be on the schedule from the prior period. So although this schedule looks quite complex, if it was correct in the prior period, the only changes you need to do is to track the things that are included in it, which you can find from your general ledger, and the things that were decreased from it, give the detail to your accountant so they can update the schedule, the depreciation schedule, and then calculate the depreciation per category upon that. All right, given that, we're just going to do a pretty basic journal entry. At this point, we'll talk more about the adjusting entry and the depreciation related to it when we get to our adjusting entry. So let's go to the practice tab and let's do it. Let's do some cleanup work on the left-hand side. So I'm going to clean this up, put my cursor on the skinny column and dragging over to A, right-click and hide those cells. And then I'm going to take my ending balances and make them our beginning balances. So we're going to copy the ending balances, making those our beginning balances. And I'm going to paste them 1, 2, 3. I'm going to delete the stuff we did last time so we can work on what we are doing now. So I'm going to imagine a situation that these are the only two accounts I have, and now I'm talking to my tax preparer, and they're saying, well, this is our depreciation schedule. And I'm going to say, well, okay, well, maybe I'm going to change these numbers to match the depreciation schedule and do a journal entry to do that. So if I go to my schedule here, they've got two categories of our activity. The one category has all this stuff in it, but really it just comes out to that 98,000, which was kind of like our starting point. And then the machinery and equipment has that 5,000 in it down here. So I'm not going to worry about all the detail because the detail is going to be something that I'm going to depend on this schedule and my tax software to give me. Rather, I'm just going to break out the categories here in my accounts and enter a journal entry to make that categorization. So let's do that. I'm going to go back on over and I'm going to say, okay, this is furniture and equipment. I'm going to change this account now to just furniture and fixture, which is what is shown on the tax return instead of furniture and equipment, which is sometimes given in software like QuickBooks, sometimes uses that as the name. I'm not sure exactly why, maybe to group those two things. But in any case, I'm going to say furniture and fixture, which is often what you see in the tax software. And then the accumulated depreciation, I'm going to abbreviate it now. I'm going to call it ACCDPRE for accumulated depreciation to give us less room for that really long word. And then I'm going to make it for furniture and fixture. Now, if you did this in accounting software, you could make what they often call subcategories. So you could, for example, make another category called furniture and fixture, and then the subcategories of furniture and fixture or accumulated depreciation underneath it, so that when you put it on the reports, you can show it as a subcategory, grouping them together or giving you the detail. Or you can just make the furniture and fixtures the parent account, and then the accumulated depreciation related to it, the subsidiary account, which gives you a similar kind of layout, and that allows you to kind of break it out And that gives you the sub accounts gives you a little more flexibility in accounting software, another added detail that a database program can give you, which is a little bit over and above what you can do in an Excel sheet. However, when we create our financial statements from the Excel sheet, we have the different options that are similar to sub accounts, meaning I can report this just as, one account. I can combine these together. I can report the detail on it. And those are decisions that we would need to be making when we create our financial statements, which we'll take a look at when we do the financials at the end of the section. So I'm going to add 2 more accounts for machinery and equipment and the related accumulated depreciation. So I'm going to select these 8 cells, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 cells, right click and insert, shift them down. And then I'm going to make machinery and equipment, because that's the second account that we have here. These all have really long names. Second account type, and then I'm going to call it ACCD standing for accumulated depreciation. And then we're going to say machinery and equip. I'm just going to stop it at equip right there so we could fit it. And then we're going to put our zeros at the starting point. And then I'm going to just tie out our numbers to the ending balances. So this is at 103. It needs to be at, according to the schedule, the 98. And the other one needs to be at the 5,000. So that means I need to decrease this one by 5,000 and increase this one by 5,000. So let's do that with a journal entry. So I'm just going to say journal entry as of 2/28. Let's say we're going to be increasing the machinery and equipment, and the other side is going to be decreasing the furniture and fixtures, just to recategorize these items. Indentation, and it's just going to be for the 5,000. That's 8,000. We need 5,000. And we'll record it out. So here's the machinery and equipment. We're going to put that right here in X12 equals, scrolling down to the machinery and the equipment. And it increases to 5,000. And then we'll record and decrease the furniture and fixture, which is in X10 equals, scrolling down to the 5,000, bringing it down to the 98. So now we've got the 98 and the 5,000, which matches our schedule over here. And we can then use this depreciation schedule, which we are imagining coming from the tax software, to help us record our depreciation. This is the depreciation on the left-hand side. We're not going to record the depreciation yet. We'll do that at the end within our adjusting entry process. So I won't talk about, how to calculate that yet, but it will be easier if we think about lining up our categories and how we're going to do that first. So now that we have this, let's report this on our GL. So we're going to go machinery and equipment. So that's going to be the debit. Well, let's go to the furniture and fixture first, because that's going to be easy. Let's do the furniture and fixture, which we have. That's at 228. And we are in AS6 equals left to the wall. Scrolling down, picking up then the credit of the 5,000. Now the machinery and equipment, we've got to add that account, and we're going to add those 2 accounts after these 2. So I need a new couple accounts right here. So I'm going to put my cursor on the skinny over here, on the skinny over to the AT. It's at the at, and then Control C, and then we're going to insert it into the skinny column. Right click and insert the copied cells to the skinny. Gonna delete the stuff that's in there right now. Delete the beginning balance like so. Scrolling down, same thing down here. And then we'll make this one. This will be our machinery and equipment. So equals, scrolling to the left, we're picking up the machinery and the equipment for that one. And then we're going to scroll down here, and then AV14, this will be the ACCD pre for machinery and equipment. I don't like the capital. Why do I have a capital on that one? ACCD pre. It just sounds cool. ACCD pre. Okay, and then we can post over here. So now we're in 228. So we're in all 5. I'm in awe of the new cell. It's better than awesome. It's awe-inspiring and then some. Awesome's not even special anymore. It's awe-inspiring and then some. Awe-inspiring and then some. So there we have it at the 5,000. Let's add that then to our check numbers over here. Double clicking on the check number. We're going to go to the end of it and say plus, and then put the cursor back down, picking up those two numbers. And we're going to say this is going to be the 5,000. Oh, wait, that's the wrong one. We're going to say this is going to be, I think I messed it. I'm going to undo this. Undo, and let's do it again. Double click on it, go to the end of it, plus. You don't have to undo it. You probably did it right. But I'm going to undo it because I got a little something messed up here. Then we'll set the 5,000 and then the 0 over here that we haven't posted anything to yet. And so now we're back in the balance, back in balance again. And so that looks good. So now we've got our categorizations to go forward, and we've got the related accumulated depreciation. So now you can see the detail that we can then put into the balance sheet if we so choose, saying here's the amount for furniture and equipment that should match the subledger. Here's the accumulated depreciation, the difference between the two, the $90,500 being the book value. We can do the same for the machinery and the equipment. If we had the sub-accounts, then we can collapse these two together to just see, in essence, the book value. We can also collapse the whole thing together, being in the category of furniture and fixtures, in essence, just showing this number of the 95.5 for the total kind of book value of the total furniture, any fixture or depreciable assets. So here's where we stand at this point in time. This is our trial balance now. So you could check out and see if you are at the same area, and then we'll step on forward. We'll keep stepping forward next time from this point that we're standing at.